So sooner or later, every investor hits this point. You need some cash from your portfolio. But what's the smartest, most tax-efficient way to actually get it? In this explainer, we're going to break down the strategic options so you can make the right call. Okay, so the day finally comes. Maybe it's that down payment on a new house, a kitchen renovation you've been dreaming of, or some other big life event. You've been investing for years, and now it's time to tap into that money. Let's say you need $100,000. The obvious move is to just sell some stock, right? Well, as you're about to see, the obvious path isn't always the smartest one. And here's why. The second you sell an investment that's gone up in value, you create what's called a taxable event. Meet the villain of our story, the capital gains tax. It's this hidden cost that can take a huge bite out of the cash you were counting on. But don't worry, you've got options. We're going to walk through 3 totally different paths you can take to get that cash. Each one has different consequences for your tax bill and, honestly, for your long-term financial picture. Think of it like a choose-your-own-adventure for your money. But before we dive in, we've got to get one key term straight: the long-term capital gain. It's basically the profit you make from selling something you've owned for more than a year. Now, the crucial thing to remember is that this profit is taxed at special, lower rates than your normal income. And really understanding this is the key to the whole strategy. All right, let's start with path number 1, the simple, straightforward sale. You need 100 grand, so you sell 100 grand worth of stock. Boom, the money's in your account. It's clean, it's easy, but what did it actually cost you? Let's crunch the numbers. Selling that $100,000 of stock creates about $8,600 in new long-term capital gains. See that top line? Now, when you add that to other gains you might have had, your total taxable gain for the year jumps up to over $24,000. That new $8,600 is the number we really need to watch. So what does that mean for your wallet? Well, that new gain translates directly into a higher tax bill. Depending on your income, you're looking at an extra $1,300 to $1,700 in taxes. That's cash that goes to the government instead of into your pocket. Okay, but what if you need more? Let's up the stakes. Path 2 is all about what happens when you need to raise $150,000. Again, it's just a simple sale, only bigger. And as you can probably guess, a bigger sale means a bigger tax problem. The math here really shows how quickly this thing can get out of hand. That $150,000 sale now triggers $26,000 in new gains. Look at how that pushes your total gain for the year to almost $42,000. The cost of just doing this simple thing is starting to add up fast. And here's where it really hits home. That larger gain translates to a tax bill of somewhere between $5,600 and $7,500. We've gone from a manageable ouch to a, whoa, that's a serious chunk of change, just by needing an extra 50 grand. This really begs the question, there's got to be a smarter way to do this, right? And that brings us to path number 3, the strategic route. This approach is designed to get you that same $100,000, but without triggering those immediate, painful capital gains. It's a little more complex, for sure, but the payoff can be huge. Here's the play. It's a 2-step move. First, you sell about $65,000 worth of stock, but you do it strategically. You pick assets that have little to no gain, so there's nothing for the IRS to tax. Then, for the other $35,000, you don't sell at all. Instead, you borrow it using a tool called a margin loan. Now, you probably caught that word margin. Don't let it scare you. A margin loan is just a loan from your brokerage firm where your own investments act as the collateral. The real beauty of it is that it gives you cash in hand without having to sell your securities and trigger that taxable gain. But listen, the margin loan is only half the story. The true power of this strategy is what it lets you do later. By not being forced to sell your winners, you give yourself the flexibility to use a really powerful technique called tax loss harvesting, which is just a fancy way of saying you strategically sell investments that have lost money to cancel out the taxes on your gains. And this right here shows why what you own matters just as much as how you sell it. If your money is in mutual funds, you kind of own the average of the market. But with individual stocks, oh, that's where the magic happens. Some go up, others go down. That volatility actually becomes your friend because it gives you the chance to sell specific losers to create tax losses. Those losses can then wipe out the gains you realized earlier, potentially crushing your tax bill. So we have 3 very different paths: the simple sale, the bigger simple sale, and this more strategic route with margin. How on earth do you decide which one is right for you? It is definitely not a one-size-fits-all answer. The answer comes down to one critical number: your taxable income for the year. This is, without a doubt, the single most important factor in figuring out what tax rate you'll pay on any of those capital gains. This chart is basically your playbook. These are the projected capital gains trends brackets for 2025. Now look, if you're married and your taxable income is under about $97,000, you're in the 0% bracket. Realizing gains could literally be tax-free for you. But for most people, income falls into that really wide 15% bracket. And that's where the simple sale really starts to hurt, and where the strategic path really starts to look like a genius move. And just remember, your taxable income isn't just your salary. It's the whole shebang: your wages, any dividends and interest you earn, and this is key, the capital gains themselves get stacked right on top of everything else. All of that together determines which bracket your gains will fall into. Okay, let's bring this all home. We've explored 3 different ways to get cash from your portfolio, and each one has its own outcome. So what's the one big lesson we should take away from all this? This table puts it all in perspective. Path 1 is simple, but it comes with a tax bill. Path 2 is also simple, but triggers a much bigger tax bill. And Path 3, the strategic route, gets you the cash with 0 gains up front, giving you the flexibility to lower your overall tax bill later on. So the crucial point is this: just selling assets whenever you need cash is the default option, sure, but it's rarely the most efficient one. Being strategic about how you access your money and actually planning for it ahead of time is absolutely critical for keeping more of your wealth and paying less in taxes. And that leaves us with one final question for you to think about. Is your portfolio actually built to give you these kinds of tax-smart options, or will you be stuck with that simple and, frankly, more expensive path the next time you need to access your hard-earned money? Thanks for joining us.